Hey guys, welcome back. Today we're going to be talking about the math behind investing in real estate and show you just how powerful of an investment vehicle real estate can be. So I think that everybody should be investing in real estate and have it as part of their portfolio because the returns are obnoxious. Now there's a couple of reasons why investing in real estate can be so lucrative, and the first is that it's basic supply and demand. Everybody needs a place to live. So there's always a very steady, very high demand for these real estate services. And the second reason is because real estate has so many tax advantages that go along with it. The tax code was written hundreds of years ago by old rich white dudes, and they wrote the tax code in their favor to benefit themselves. If you were rich a couple hundred years ago, you were a landowner. So they wrote the tax code specifically to benefit landowners. So let's go through a typical scenario and show you just how obnoxiously powerful investing in real estate can be. So let's go through a typical scenario, and let's say that we bought a property that was worth $300,000. We used a 20% down payment, so we got a loan for $240,000 at 5% interest rate. Now, the numbers are rough estimates just to make the math a little bit more convenient, but in our example, this mortgage payment is going to be about $1,600 per month. And let's say that during that first year, we rented out for $2,100 per month. That's what we charge in rent. So $2,100 a month is a little over $25,000 per year in revenue that we're getting. Now, typically when you make more money, you make $25,000, the IRS wants taxes on that money. But this isn't $25,000 of pure profit because we have business expenses. We are in the business of providing real estate, rental properties, so we are able to claim business expenses against that income. So let's start breaking things down. And we're going to start with our mortgage payment. Now, typically a mortgage is made up of four distinct parts. We have our principal, interest, taxes, and insurance, sometimes referred to as your pity payments. So here our principal, if it's $1,600 a month, our principal is going to be about $300 per month. So that is how much money of this $1,600 is actually going towards repaying the loan. That's how our loan balance gets paid off, is the principal. All right, and next up we have our interest. So this $240,000 at 5% interest, we're paying roughly $1,000 a month in interest during that first year. Taxes, property taxes, let's just say that that's going to be, $200 a month. And then insurance, let's call that $100 a month. So here is $1,600. That's the breakdown of what our mortgage payment is actually paying for. But if you look at these four things, three of these things are business expenses. The only thing that's not a business expense is this amount of money that is going towards the principal. So the overwhelming majority of this money, $1,300 a month, is a business expense that we can deduct from our income. All right? But it gets a little bit better because we're not done yet. We got more expenses that we need to add on. So hypothetically, let's just say that we use a property management in order to run this property for us. They're the ones that go out and select tenants and sign leases and collect payments. They're the ones that doing all of the legwork for us. So let's just say that costs us $150 a month for property management. All right. And then we've got some more stuff. We're going to have things like vacancies. We're going to have repairs that we got to make. Now, in a normal month, probably nothing breaks. But when things do break, it's probably a little bit expensive, right? A hot water heater might cost you $1,000. So if you average all of those expenses out, hypothetically, let's just say that those expenses, vacancies, repairs, CapEx, all that stuff, let's just call it $350 per month. for repairs. All right. So now we've got an extra $500 per month in expenses for all of that stuff. So now we're up to $1,800 per month in expenses. And if you take 1,800 times 12, that's hard to do in your head. 2,100, 600, give or take. If I'm wrong, sue me. So $21,600 per year in expenses. So if we have that much in expenses, then we're pretty close to offsetting this $25,000 in income. But it gets better. You see, one of the biggest tax deductions in real estate is depreciation. Depreciation is basically the IRS way of saying that over time, stuff gets old and stuff breaks, so you got to replace that stuff. So in this case, the stuff that is getting old and will eventually need to be replaced is our house. So we can depreciate the value of our house over the next 27 and a half years. That's the way the IRS has it set up for depreciating single-family homes. Now, we can't depreciate this whole $300,000, so the way the IRS says to do it is to break up our property into two different concepts. One is the raw land, like if there was no house sitting on top of it, just the land itself has some value. And then the second one would be the house itself, the structure. So you have the land and you have the structure. Now, you can usually get the value of the land from like the county assessor's office or something like that when they're calculating your property taxes. They calculate the value of the land and the house separately in most cases. So let's say that the value of our land was $25,000 and the value of the structure itself, the house, was $275,000. So if the structure is worth $275,000 and you get to depreciate it over the next 27 and a half years, that comes out to $10,000 per year in depreciation. $10,000 every single year for the next 27 years as a tax deduction. So now we're up to $31,600 for our expenses. All right? But remember, we only made $25,200 in revenue for the year. So according to the IRS, we are losing money. If you take 31,600 minus 25,200, that's what? $6,400 loss. According to the IRS, we lost over $6,000 in that first year. But did we really lose any money? No, it's just some fancy BS accounting procedures that showed that we lost some money. Realistically, if we're just counting the number of dollars in our wallet or dollars in our bank account, we broke even, right? We collected $2,100 per month. $1,600 of it went to the mortgage, and then $500 of it went to these miscellaneous repairs and management type expenses. So we had 21 coming in, we had 21 going out, no cash flow, we just broke even. But according to the IRS, we lost money with their fancy-dancy calculations. So what does that mean? Well, it means that we can take this $6,400 loss and use it against our own personal income if you have a job. So hypothetically, let's say that you have a job and you earn $50,000 a year. But if you earned $50K a year and owned this rental property, you could deduct this $6,400 against your $50,000 that you earned, so you wouldn't be taxed on the full $50,000. Instead, the IRS would say that instead of earning $50,000, you really only earned $43,600 after accounting for this business loss. Now, all of this stuff is calculated separately. This is a business deduction. So you can still claim your normal personal deduction that most of us claim when you're filing your taxes. So you can still get that sweet $12,000 or $13,000 deduction, whatever it is, for the standard deduction and claim this loss. Because the standard deduction is a personal deduction. This is a business deduction, so you can get both. You don't have to itemize your taxes in order to claim this loss. So, according to the IRS, we lost $6,400. As far as cash in our pocket, we realistically just broke even. But what about our net worth? What happened to our net worth over the course of the year? Well, our net worth actually went up because this $300,000 property is no longer worth $300,000. If nothing else, inflation is going to cause this property to be worth more money. Now, recently we've had some stupid high levels of inflation, but let's just say a more conservative, realistic, long-term number of 3%. Right? So if the value of this property went up by 3%, it's no longer worth $300,000. It's now worth $309,000. It went up in value by $9,000, 3%. In addition, now we no longer owe $240,000 on this mortgage because we've been making $300 a month payments towards the principal to repay this balance. So we've paid $3,600 per year against that loan. So now our loan is going to be, what is that, 36.4K? Something like that? Yeah. So our property went up by $9,000. We repaid $3,600 on the loan. So what happened to our net worth? Our net worth increased by $12.6K net worth. All right. Now, if we take that increase in our net worth and compare it against the original investment that we had, remember we put down $60,000 as part of this down payment. So $12,600 return on a $60,000 investment, that's over a 20% rate of return. That's, I don't know what that turns out to be, 21, 22% return on your investment. Now, for argument's sake, the long-term historical rate of return for the stock market is only about 10%. So even though we just broke even on our cash flow for the year, we still more than doubled the returns of the stock market. Now, this is only during year 1. What happens during year 2, year 3, year 20? Well, it stands to reason that if the property itself went up by 3%, then chances are rent is also going to go up by 3%. So next year, we're not collecting $2,100 per month in rent. We're collecting $2,100 plus an extra 3%. So what is 3% of 2,100? 60, 63, 2163 per month. So that's our year 2 rent. We raised the rent on our tenants by $63 per month, which is 3%. So now we're making a little bit of money every month. We're making an extra 63 bucks. But our expenses are also going to go up, but by not as much. You see, if we look at all of this stuff for our mortgage payments, this stuff right here, the principal and the interest, is a fixed rate item. As long as you don't have an adjustable rate loan, this portion of your mortgage payment is going to stay the same. It's not affected by this inflation. It's going to stay the same. So yes, our management expenses might go up by 3%, our maintenance repairs might go up by 3%, our taxes might go up by 3%. A lot of this stuff might go up by 3%, but $1,300 of it is going to stay the same. So our revenue is climbing faster than our expenses because a large part of our expenses are fixed. So during year 2, we're going to make a little bit of cash flow every month. During year 5, we're going to make even more. During 20, etc. So as time goes by, the amount of cash that we're collecting in our hands is going up. But we're still able to claim all of these various losses. But realistically, we're not done claiming losses. We can do even better than this, because the moment you start owning a business, you can start deducting so many things from your taxes. So hypothetically, if I have a management company that's running this property for me, they need a way to get in touch with me just in case there's something that goes wrong with the property. So now a portion of my cell phone becomes a business deduction. Both when I go out and buy a new cell phone, if I want to go buy an iPhone version 23 Pro, whatever they're up to nowadays, a portion of the cost of that new phone is a business expense. A portion of the monthly cell phone bill is a business expense. If I need a computer to analyze properties to see what I'm going to buy next, then a portion of the cost to buy a new computer is a business expense. A portion of the internet that I use is a business expense. Now I need a place in order to actually do all of this stuff. So if I have a dedicated space in my home that I use as a home office, that's a home office business deduction for at least a minimum of $500 per year in deductions. If I spend gas to go drive to my house to go view it, if there's something wrong, that's a business expense. If I have properties that are in another state, if I have properties in Las Vegas, I could fly over there, check up on my properties, and that plane ticket would be a business expense. Now, if after checking up on my property, I just happen to go to the strip and do some gambling later that evening and get some personal enjoyment out of that trip, well, that's just a bonus. The trip itself is still a business trip because I went there primarily to check up and review and maintain my property. So as you can see, overall, we made $12.6 thousand worth of net worth, 20% rate of return. We were able to claim a loss against our regular income, and we just broke even. Now, some of you guys might be saying, yeah, but don't you eventually have to repay this depreciation when you sell your property? Yes and no. You see, typically when you sell your property outright, you're going to have to pay what's called depreciation recapture, and there's some math involved on that. But what if you just don't ever sell it? Or what if you sell it, but use what's referred to as a 1031 exchange to use the proceeds from that sale to go buy a different investment in real estate? What a lot of people do is a handful of years down the road, they'll sell this property after it's gone up in value, and they'll use the proceeds from that to go buy a small apartment complex, maybe a 10-unit apartment complex. And so you just keep on putting off and delaying and delaying and delaying, ever repaying this depreciation cost. And eventually you delay it long enough where you just die. And when you die, this tax bill, this tax depreciation that you've accumulated over the last few decades dies with you. Your kids don't have to pay this depreciation recapture, and it just simply goes away. If you enjoyed this video, consider subscribing, leave a thumbs up for the YouTube algorithm. I love hearing comments from you guys, so leave a comment down below. And as always, I'll see you all again next time. Thanks.